Welcome to Sophie Daddy's channel. All right, let's get right into it. Today, we are pulling back the curtain on something huge, a force in the market that's super powerful, but honestly, not a lot of people really get it. I'm talking about gamma exposure, or GEX. Now, this isn't about earnings reports or what the Fed's going to do next. This is about the market's hidden plumbing, the actual engine under the hood that's pushing prices around. So, you ready? Let's dive in. Just let that sink in for a minute. The tail now wags the dog. I mean, for years, right? We were all taught stocks move because of fundamentals, how good a company's doing. But what if that's just not the full picture anymore? This quote right here, it nails the new reality we're in. The options market, this massive beast, isn't just following the stock market. Oh no, it is driving it. It's all about the banks and dealers having to hedge their positions. And that forced action creates these huge, predictable waves of buying and selling that can literally steamroll everything else. Okay, so here's the game plan. First, we'll talk about the why, the hidden engine. Then we'll get into the physics of it all. After that, we'll look at the two different markets GX creates, how to read the gamma map, the absolute game changer that is 0 DTE options, and finally, the fun part, how to actually put all this stuff to work. Look, we are in a totally new world. The amount of options trading happening right now is just staggering. And because of that, the mechanical need to hedge these trades forces billions with a B of dollars into and out of the market every single day. This creates waves so big they can completely overpower anyone who's just looking at a company's balance sheet. Seriously, understanding these flows isn't just an edge anymore, it's pretty much a requirement. So to really get GX, we first have to wrap our heads around the basic physics of the options market. But don't worry, I promise this is way more exciting than your old high school physics class. It all boils down to a few key players and the simple, unbreakable rules they have to follow. So the main characters in our story, the market makers, you can just call them dealers. Whenever you buy or sell an option, there's a good chance they're on the other side of that trade. But here's the thing, they're not trying to bet against you. Their entire job is to stay neutral. They make their cash on the spread, and to do that, they have to constantly hedge their risk. And it's that constant, mandatory hedging that creates the entire GEX effect we're talking about. First up in our physics lesson is delta. The easiest way to think about delta is as the velocity of an option's price. So if an option has a delta of, say, 0.50, it means for every dollar the stock moves up, the option's price goes up by 50 cents. For the market makers, delta is their instruction manual. It tells them exactly how many shares of a stock they need to buy or sell to stay perfectly neutral. It's their starting point. And now for the star of the show, gamma. If delta is velocity, then gamma is acceleration. See, it doesn't measure the change in the option's price. It measures the change in the option's delta. And this is the key, you guys. Gamma tells the market maker how much their hedge is about to change as the stock moves. If gamma is super high, it means their position is really unstable, and they're going to have to trade like crazy to stay neutral. So let's just boil it all down. Delta tells a dealer what their risk is right this second. But gamma tells them what their risk is going to be in the future if the price moves. And that's why gamma is the engine. It's the thing that forces the dealers to act, and that forced action is what creates these powerful, predictable waves in the market that we can actually track. So what in the world happens when you take all the gamma from every single options contract out there and add it all together? Well, you get one of two completely distinct market environments. It's almost like someone flips a switch, and suddenly the market starts playing by a totally different set of rules. Right, so when we pile up all the gamma from all those calls and puts, the dealer's net position creates this massive feedback loop. And this loop does one of two things. It either calms the market down and keeps it stable, or it pours gasoline on the fire. And this slide just lays it out perfectly. In a positive gamma world, dealers are like shock absorbers. They're forced to sell when prices rally and buy when prices dip. This action suppresses volatility and keeps the market kind of stuck in a range. But in a negative gamma world, they become the fuel on the fire. They have to buy into rallies and sell into dips, which just amplifies every single move and creates these really powerful runaway trends. Now here's the really cool part. This GX data isn't just some abstract number. We can actually map it out across all the different price levels. And when you do that, you get this incredible map of support and resistance that isn't based on some old lines on a chart. No, it's based on the real money positions of the biggest players in the game right now. The most important spot on this whole map is the gamma flip. You should think of this as the border crossing between those two regimes we just talked about. When the market price is above this level, the shock absorbers are on. The moment it falls below, they're gone. This level is, quite literally, a volatility switch for the entire market. Okay, next up is the call wall. This is simply the price level that has the biggest pile of call options. Now, as the market rallies up towards this wall, the dealer hedging gets so intense, they have to sell more and more stock that it creates this incredibly powerful ceiling. It effectively puts a lid on the market's rally. And just how powerful is this ceiling? Get this. Historically, the market has closed below the call wall on expiration day about 88% of the time. That is not a guess. That's not a pattern. That's a structural reality because of the mechanics of how this all works. And on the other side of the field, we have the put wall. This is the price with the biggest concentration of put options, and it usually acts like a really strong floor of support. As prices drop towards it, all that dealer hedging creates a lot of buying pressure, kind of cushioning the fall. But be careful. If this wall breaks, it can trigger a super fast gamma flush to the downside. Okay, now we need to talk about the modern market, because everything we've just discussed, it's been amplified like crazy by the explosion of what we call zero day to expiration options, or zero DTEs. These things have put the entire GEX dynamic on steroids. Just take a look at this. On any given day now, more than half, over 50% of the entire S&P 500 options volume expires that very same day. This isn't some tiny niche product anymore. It is the market. And it's creating these massive but very short-lived gamma effects every single day. So why are zero DTEs such a game changer? It's basically these three things. 1, gamma gets insanely high as an option gets closer to expiring. It just skyrockets. 2, this forces dealers to hedge right away, instantly, causing these wild, sharp price swings during the day. And 3, all this action creates predictable little patterns within the trading day itself. And this is often what a day looks like because of it. You'll get a trend in the morning as dealers have to chase the opening move. Then, often around noon, you'll see a reversal as time decay really starts to kick in. And finally, in that last hour of trading, prices often get pulled toward whatever strike has the most gamma, like a magnet, creating this pin right into the closing bell. So, we get the theory, right? Now let's get to the good stuff. How do we actually turn all this knowledge about GEX into a real trading edge? Let's walk through 2 core strategies. Strategy number 1 is the mean reversion play. Okay, so when the market is in a positive GEX regime, which means it's trading above that gamma flip level, the dealers are those shock absorbers. The playbook here is actually pretty simple. You fade the extremes, you look to sell rallies as they get close to the call wall, and you buy the dips when they test the put wall, basically playing for the price to snap back to the middle of the range. And strategy 2? It's the complete opposite. When the market is in a negative GEX regime, the dealers are amplifying moves. Here, you absolutely do not want to fade the extremes. You do the opposite. You want to buy the breakouts and short the breakdowns, because that dealer hedging is now the fuel on the fire, creating these strong, fast-moving trends. And we can get even more specific. One really powerful trade is to go long the second the market climbs back above that gamma flip level from below. Why? Because what was a headwind instantly becomes a tailwind. You can use the call wall as a super logical place to take profits. And for entries, you can look for these low gamma pockets where price can move really, really fast from one key level to the next. At the end of the day, what GEX really gives you is a structural edge. You're not just looking at chart patterns or trading on a gut feeling anymore. Instead, you're actually aligning your strategy with the single biggest mechanical force in the entire market, the forced hedging by the dealers. You're basically trading with the house. And that's our deep dive into the market's hidden engine. We've uncovered the physics, the 2 different regimes, and the key levels that are really driving the price action every single day. So, the final question? That's for you. Now that you can see this hidden architecture, now that you have the map, how are you going to use it?